With the growth and evolution of the alternatives landscape, we believe now is the time to explore different ways clients, prospects, and advisors can start using alternatives to enhance their practices and portfolio construction. Whether you're looking into private market investments for the first time or aiming to deepen your expertise, this session will help you better understand why alternatives are such an essential part of client portfolios and how you can tailor solutions that address your clients' investing goals. This presentation, led by Brookfield Oaktree Wealth Solutions' Nicole Pecoraro, Senior Vice President of the Alts Institute, and Josh Rizak, Alternative Investment Strategist, provides insight into the historical growth of the alternatives market, the primary drivers of this interest, the benefits of investing in private markets, an overview of investment vehicles, and key considerations for incorporating alternatives. Let's join Nicole and Josh as they examine the forces at play in the alternative space and offer practical insights and expert perspective on accessing private market opportunities.
So in today's webcast, we're going to be taking you through private markets, why we feel they're such a necessary part of a portfolio, not just because we're an alternative asset manager, believe me, but we're also going to be walking you through different types of entry points and even vehicles that you can access for your clients. We do know that not all alternative investments are right for everyone. So ways to create bespoke solutions for your clients, prospects, and investors with different options that are in today's markets could be helpful, and then being able to walk clients through what would be beneficial for many of the folks on today's call moving forward.
Great, thanks, Nicole. So, just to kind of reinforce that, in today's presentation, we hope you're able to take away how to define alternatives, the attractiveness of private market solutions in an alternative portfolio, and to walk away with a better understanding of the different investment vehicle options that are available to private wealth clients today.
Let's define alternatives. I think the word alternative is thrown around quite frequently these days with many clients and prospects, even some folks in the industry, maybe not even realizing what constitutes as an alternative investment. Really what it boils down to is an alternative investment is a financial asset falling outside of traditional investments, such as stocks, bonds, and cash. That's the definition in its simplest form. However, what is important to note is that alternatives mean different things to different investors and people. Each investor has their persona with what their needs might be and what type of investment capabilities, risks, and growth you as advisors can help to discuss and navigate with them.
So as you mentioned, alternative investments mean many different things to different people. They can play both an offensive and defensive, risk and volatility reducing role in a client portfolio. I think this is very important to think about when considering allocating your client capital. In this chart, we are trying to break down the different rubric of alternatives based on three key characteristics: the asset class, the investment strategy, and the type of investment vehicle. There is basically a taxonomy or hierarchy of how to think about the three concepts just mentioned. For example, private real estate is the asset class. The investment strategy, which is the stylistic approach to the asset class exposure within real estate, could be core, core plus, value add, opportunistic, debt, or secondaries. And lastly, you think about the investment vehicle or fund wrapper, which is the structure, entity, feeder that pools investor capital to invest in these asset classes. In real estate, that may be a limited partnership, a limited liability company, a mutual fund, a closed-end fund, a real estate investment trust. This same taxonomy or hierarchy can be overlaid for private equity, infrastructure, and private credit among the different alternative strategies.
I think this is a really interesting visual, just showing how far we've come historically in the investment space on the public side and moving forward in the alternative side. It really illustrates that we're on the precipice of a new movement in investments, and alternatives are at the forefront of this. So if you look all the way to the left in the late 17th century and even the 1800s, this is really when professional reporting, accounting, and many companies started and were able to provide consistent financial data. And then if you fast forward to 1933, it continued to change and provide more information to the public when the SEC was created. And by the early 2000s, public securities, regulation, and release data was made available simultaneously to all investors. We mentioned this today because it's extremely relevant to look at the private markets by and large and how they're actually evolving much like the public market. The amount of perpetual vehicles, the access to information, and the data that the general investor is able to receive continues to grow, and makes it easier for investors and their advisors and clients and prospects to access what's best for them in a timely manner.
In the attached chart, you can see the dynamic growth of private market AUM since 2000. The market has grown almost 20 times in size over that 23-plus year period, and I only think this is the tip of the iceberg in terms of client adoption. What was once a nascent, misunderstood asset class has become more mainstream for institutional investors and has subsequently become more Main Street for private wealth investors over the last 5 to 7 years. For institutional investors, the adoption of endowment-style investing and the tilt away from traditional 60-40 stock-bond portfolio construction has been a 20-year process. And those who don't use alternative investments in that space, in their asset allocation models and portfolios, are more the exception today. The growth, as you kind of mentioned before, in private market investment for private wealth clients has been more of a recent phenomenon. Not surprising, mainly because three things needed to happen to kind of trigger that growth. First, demand. Advisors and their clients had to learn the benefits of how incorporating alternatives into their portfolios can enhance their portfolio, reduce market volatility, and increase returns. Second, I think about it as almost like the barriers. Let's refer to that as the operational complexity around that. For many wealth advisors, the technology and the operating platforms or the plumbing of making these investments didn't exist. So either it was too complicated to access private markets efficiently, and now we're at a point where being able to review and look at client performance on client statements, capital calls, getting monthly statements is less complex and more accessible to people. Then lastly, let's call it the supply. Once we saw that there's more demand and interest from the private wealth channels, GPs or asset managers spent more time figuring out how to provide their products and investment expertise to a wider audience. They created investment vehicles that were more wealth-friendly, that allowed lower minimums and more periodic liquidity. So when you combine all those factors together, you can see how since 2015, AUM in private markets has increased from $4.6 trillion to $15+ trillion. And I think we're just at the launching point for broader growth.
Here, when you're speaking about kind of expanding and broadening, it's really the access to these private investments that clients have now. And we at the Alt Institute like to call them the core four, right? You've got infrastructure, real estate, private credit, and private equity, all becoming more and more accessible to investors. And what this creates is wealth opportunities, but through diversification, enhanced returns, you've got some income generation there, all the while, which I think is really important, in minimizing market volatility. And that, Josh, I think is at the forefront of, I believe, a lot of investors' minds these days. And, as with anything, there's obviously considerations to review, some illiquidity, there is some still limited information that's out there, and higher fees. But we at the Alt Institute and others in the field can help folks and advisors explain the complexity of these investments. There's certain complexities that we can look to educate investors on. So they'll be able to understand the differentiated details of these types of investments. And then you all as advisors are able to have the conversations with prospects and investors and clients and be able to add that value that you do on an everyday basis.
Yeah, I mean, I think, Nicole, even before jumping here into correlation, complexity and making things simple, right? When you think about real estate as an asset class, many investors own their homes. They're more familiar with it. They walk around, they see apartment buildings, they see logistics centers, they see multifamily dwellings. So you have to, when you take concepts and make it more simple, or infrastructure, what's a cell phone tower? How do you get products delivered to you? When you simplify these complex concepts for people and educate them, I think it creates a better access point to have that conversation on how they can include that in their wealth portfolio.
Reiterating the fact that the potential benefits of investing in these private markets are what we've been focusing on for a very long time in a client portfolio, which is diversification and the minimization of the volatility and the returns, as I just touched upon. So.
Sure. And, I think the environment today in equities and fixed income presents a great conversation around reducing and trying to minimize volatility. And really, as we scroll through these next slides, you're going to hear the story of why it's appropriate for your client's typical portfolio. But to reinforce a couple points that you just made about how to incorporate alternative investments in a 60-40 portfolio, in certain time periods, the correlation between stocks and bonds increases considerably. We saw that most recently in the 12-month rolling period in 2023 when they correlated at 0.88, which was a significant increase over the prior 3 years and a huge increase over what we saw in the 7 years prior. The key takeaway that I see here is that by incorporating alternative investments in a portfolio, you can help minimize that correlation when markets become more challenged. Over the almost 15-year period, when you look at the correlation between global equities and the various alternative asset classes and bonds and all asset classes, the correlation since 2008 is minimal. So when you look at global stocks relative to private equity, which would be a private market equivalent, it's 0.78 correlation. When you look at global stocks relative to private credit, it's 0.7. Those are more correlated to one another, but when you drill down into other asset classes, more real assets, as we'll call them, when you look at stocks relative to private real estate, it's a 0.38 correlation. And when you compare publicly traded listed real estate to that, it's much higher, right? So the public market equivalent of a carve-out of global stocks being the publicly listed real estate, it's 0.88. So they're definitely more relatable to one another. Similarly, private infrastructure and its correlation to global stocks is almost nothing. It's 0.04. So I think that you can see the case of why. What's even more interesting, I think, in my opinion, is when you look at listed real estate to private real estate. That has a 0.37 correlation. And when you look at listed infrastructure to private infrastructure, that has a 0.11 correlation. So what you can infer here is that private assets don't correlate in terms of their performance to more beta-oriented public market equivalents. This is probably my favorite slide that I use in every client conversation. It's really the why alt slide in the portfolio, right? So when you look at risk-return contribution of a 60-40 bond portfolio, a stock bond portfolio over that 15-year period, it is historically delivered you about a 5%-ish return with a vol of 12. So you're getting okay return, but a lot of volatility. As you can see, when you start to incorporate alternatives into that mix, you can visualize, and that's the shaded green area to the left, private equity, private credit, private infrastructure, and private real estate are to the left of the 60-40 in terms of risk, and then much lower return in terms of the volatility. They provide you a better risk-adjusted return. To put some numbers around that, just kind of as we think about that, private equity gives you over that time period an 11% return with a 9 vol compared to where you see global equities on here. Private credit, a 9% return with a 4 vol. Private infrastructure, also a 9 and change return with a 7 vol, and private real estate is coming in with a 4% return and a 9 vol. Going one step further, when you compare the return and risk of private infra versus listed infra, similar to what we talked about in terms of correlation a minute ago, private infrastructure, like I mentioned, gives you a 9% return. Listed infrastructure gives you a 6% return, but with half the volatility you're getting in private infrastructure. So private infrastructure is 7 vol. So in private infrastructure, you're getting 50% rate of return for half the market risk. Similar story in private real estate. In private real estate, you're getting more return with 1/3 of the market risk of public real estate.
This is the type of data points and slide that shows what the traditionalist or your traditional portfolio would look like, from a 60-40 standpoint. And the stocks and bonds are something that each client or prospect can relate to. But when you start adding the statistics that you just went through, that's when this chart and analysis really gets interesting, especially as we're looking towards these new vehicles to access these asset classes. So I like to stress one final thought on this is that the managers and the asset classes combined can really help mitigate that risk that Josh was just referencing by accessing those private markets in a clear and concise manner and not piling it on. And those were some great examples of how we can access those markets. I think when you move forward here, alternatives have outpaced global stocks in down markets, right? So we all know too well that markets can't always go up. But much to the speaking points of risk, down markets is really also where alternatives can shine. And it's noted here that they've outpaced global stocks during the last 10 worst quarters. And if you look from left to right, private infrastructure alone and private real estate, equity, and private credit all combined are outpacing by a couple hundred basis points.
Just to kind of drill into both those concepts again, right? In down quarters for equities, so I think in over that 10 worst quarters, it averaged about down 14. So these all providing some level of alpha to the public markets. And the way alternatives and the fund structures, and which I know we're going to get into in a little bit, that is the illiquidity premium that we talk about. By locking up capital and saying, this portion of my portfolio, I don't need to be daily liquid. I need it to be sometimes liquid, and we're going to talk about evergreen structures in a couple minutes, or I have enough money and I can own something for 10 years and wait till it sunsets to get my liquidity. So that return generation and vol reduction is generated by contributing capital to something that I don't need today, but I will need in the future. If you looked at the first risk and return chart we talked about a couple minutes ago, if you kind of just take it and say, on the right, my 60-40 portfolio is giving me a return with the highest level of volatility. As you move to the left, the up and to the left, which we pointed out earlier, if you just say I go from no alternatives to 100% alternatives, you could see the return enhancement and the volatility reduction by adding alternatives to a portfolio. Each green dot on this page is a different stop along the way in terms of adding some alternatives on an equal basis between private credit, private equity, real estate, and infrastructure to a portfolio. If you equally weight it at whatever allocation here, you can see it's consistently providing a higher return and a lower volatility.
How do we suggest you use alternatives or access the private markets today? The Alt Institute suggests different allocations for different types of segments of investors. And we've actually covered that in one of our prior Alt Institute presentations that we've had. So whether you're a traditionalist, an emerging adopter of alts, or even a champion of alts, what's clear is that a diversified mix of alternatives can enhance a portfolio. And when you look at kind of the managers that are offering a spectrum of solutions to meet what Josh was just referencing on the liquidity needs, right? So you go from public markets, which are highly liquid, to the private markets, which are a little less liquid, but now with the vehicles that we're going to get into in a moment, really can be able to leg in and diversify in a portfolio. It protects on the downside and historically has elevated performance on the upside as well. So we know that you all out there have so much information thrown your way on a consistent basis that it's hard to filter it all. But if you take a look at what managers have to offer, there's a wide variety of solutions to meet investors' needs. And those barriers to the private markets from these managers for wealth are easing. There's not only many ways to access these asset classes, but resources out there for education and to take a look at the suitability, the ways to access them, and some of the regulation itself, really aligning yourself with the right alternatives asset manager and starting to enter your clients and investors into these types of asset classes we think will be beneficial in the long term.
What's really great about this is this is really the life cycle of where alternatives started. That's the right-hand chart. That's a traditional drawdown fund. And the left-hand chart, which we'll get to, if you're kind of lining up where the world was and where the world has gone, is the perpetual evergreen fund. If you think about this, again, we're trying to capture the liquidity premium. We're trying to educate on how to use different fund structures. And these two pictures here show you the different ways your client capital is put to work. And that's the blue part of each one of these charts. That's the invested capital. And the green being the liquidity or the dry powder that sits on the sidelines. So maybe just to kind of drill into the traditional drawdown fund. Think of these funds. These are available to your traditional ultra high net worth. These are the funds that institutions have been using forever, where you're committing capital. So think about a manager comes to market with a strategy and goes through a fundraising process. So during this fundraising process, you raise money for 6 to 18 months. Along the way, investors commit capital. It could be drawn during that process as the firm starts to make investments, or they can wait and trigger an investment period. So typically, following the fundraising period, the GP or the investment manager invests the capital over a multi-year period where they call LP or investor capital as they find compelling opportunities. Capital forms around any opportunity here. These could be traditional private equity. This could be private infrastructure. This could be private real estate. This could be private credit. This can be asset-based lending or even distressed debt and special situations investment. So certain ones of these strategies require long-term capital and a lockup strategy based on the style of investment mandate. Following the investment period, so after the manager finds enough opportunities and they build so call that a 3 to 5 year window, the manager is calling capital as they make investments. So your capital, and really what you're giving up here is opportunity costs because you're committing to a fund and hoping that they call 100% of your capital that you committed. But sometimes that might be only 85%. So you just don't know, but you're making a capital commitment and you have to wait. And along the way, the manager calls that capital. And as the manager builds a full portfolio, as you can see, when the invested capital becomes the full part of the chart here, they're actively trying to maximize value of these investments. And then when you hit year 5 and later in a fund life, and these funds are typically 9 to 12 year life funds, dependent on the strategy, and they will start monetizing investments. They'll start selling them as they've created value. Over that time, they're building what the actual value of a dollar is, and they're reporting to you an internal rate of return, net of fees. Really on the left side here is let's call this the new entrant to the market, the emerging fund structure, which we'll get into fund structures in depth really shortly. But the evergreen, semi-liquid, perpetual structure, which is a newer fund structure that has made accessing alternatives a lot easier for private wealth clients. Clients come into these funds on a monthly basis or a quarterly basis at the fund's net asset value. When I say net asset value, that means that these funds are valuing their investments on a monthly or quarterly basis. Whereas in a drawdown fund on the right, that's more of a quarterly basis. Because no one's coming in or out during the life of the fund, that number it's less necessary to value that on a monthly basis. Within the evergreen and perpetual structure, there is periodic liquidity on a quarterly basis. So investors can change their mind typically after some period of a soft lock and exit the fund. So within the perpetual product, which has made alternatives highly accessible for private wealth clients, you're limiting a number of things. You're limiting reinvestment risk because you're always invested, meaning you don't have to commit to a new fund vintage every 3 to 5 years. So for example, if you're an investor in private equity and you go into the structure on the right, every so often, once your capital is called and it's invested and it's harvesting, the manager who is in the business of making investments will come back to market with another fund vehicle, and you have to decide, do I like that manager, do I not like that manager, and commit capital to a new vehicle. In the semi-liquid evergreen structure, you're taking that decision and saying, I don't want to have to do that. When the manager monetizes investments in this structure, they just go ahead based on their liquidity needs and reinvest that into a new investment and don't have to distribute that capital back to fund holders. So a couple of things to note. Evergreen structures, as you can see the thin green line at the top, they keep some portion of capital for its liquidity sleeve. This may reduce ultimate returns, but it enables clients to have that redemption right I talked about, the ability on a quarterly basis to say, I changed my mind or something in my life changed or I need to change my portfolio allocation, and you can submit for a redemption. Whereas on the right side, in the fully drawn fund, what happens in 5 years if you change your mind? You can't get out. You have to wait until they harvest the fund. Net-net, the friction on returns from one to the other is probably minimal over time in terms of what's called multiple of money, what your dollar is worth at the 10-year point. It's really about having opportunity cost on how you invest your undrawn capital.
Okay. That was very thorough, and what I'd like to do is really stick with the vehicles that we're seeing come to market by way of the evergreen vehicles, or as some others call them, semi-liquid, perpetual. I think we should take a little bit of a deeper dive into each individual description and components of these types of funds, because even though they're thrown around quite frequently by way of non-traded REIT, BDC, whatever the case might be, it'd be nice to go through the details of each individualized vehicle wrapper. Let's take non-traded REIT, for example. Could you walk us through that a little bit?
Sure. Non-traded REITs, the investment trust, to kind of better define it, are designed to provide access to institutional caliber private real estate. For example, that could be, as I talked about earlier, that could be offices, that could be warehouse, shopping malls, apartments, and these tend to be stabilized assets that have current cash flow. That's generated from primarily rental income. There could be some debt exposure there as well, but to help drive that income. Non-traded REITs are really a way to access this through a long-term view, and these funds have, similar to what I mentioned, evergreen, they have the ability to have share repurchases on a monthly or quarterly basis, where investors can sell and get out of the fund. This gives investors exposure to the real estate market without that volatility that you get in private real estate. So, I talked a lot about that earlier in terms of what listed real estate performance, in terms of return and volatility are versus private real estate. And here, by going into a private structure that does not trade, you're taking out the market noise. BDCs, it's really a legal structure more than anything. It's really the container is a closed-end vehicle under the 40 Act. So it's registered that invests in the debt of companies. There's public BDCs and there's perpetually private BDCs, and there are drawdown funds that are structured as BDCs. But really they are credit origination vehicles that for the most part have to buy or originate loans. And the genesis of this really, and the growth of it, happened first following the GFC, where banks could not hold certain debt on their balance sheets. Became, the capital charges were too high. So lending to what we'll refer to as the middle market became inefficient for them. And naturally, when banks can't do it, private capital is formed for that opportunity. So these are typically loans to businesses that have $50 million to $1 billion of revenue. In some instances, they can't access debt through a bank syndication. But where the world has gone in the last 5 years as private capital has formed around this, now borrowers have choice, right? So now they can choose to do a public market syndication, or they can go to the private lender, because the efficiency of these products has been great in terms of providing a high income solution to private wealth investors. And as they formed in the last number of years, to kind of go back 5 years, first it was about the liquidity premium, earning something greater than you can get in the public market. And really over the last 3 years, as base rates have been high, it's provided a great absolute return in terms of investment profile.
Next up, we have an interval fund, which I know that's a closed-end fund. It's not traded on exchanges, but investors can buy these shares at regular intervals, quote unquote. But I'd like you to take us through that as well.
Not very different than a BDC. And the BDC can use a certain amount of leverage, a 2-to-1 leverage. An interval fund is also a closed-end structure, trades with a ticker, which is different than a subscription document that you have for a BDC, and invests in both tradable fixed income instruments. That could be leveraged loans, that could be high yield bonds, it could be securitized products, residential mortgage-backed securities, and also has an illiquid component to it. So really, the way they're managed is stylistic based on the asset manager's expertise. They provide a 1099, they use limited leverage, but really the term interval comes from their willingness or their structures requiring them to provide a repurchase on a defined interval, right? On a quarterly basis for the most part. Different than the BDC structure, which is less of a requirement, but more of a best effort in terms of providing that liquidity on a monthly or a quarterly basis.
Next up, we have the tender offer fund, which is another closed-end type of non-listed vehicle wrapper, right?
Absolutely.
Okay.
And, there tends to be less liquid investments in these types of structures. They're continuously offered. People enter at an NAV. Again, it's about providing access points for investors, and for the most part, that can be done with easier tax reporting requirements than your traditional qualified purchaser funds.
This registered private investment fund that provides maximum investment flexibility, this one's one we don't hear about as much, right?
Right. I think you'll see this more as private equity becomes more accessible in the mass affluent or in the wealth channel, in the registered vehicles. They're coming in structures as well that have higher eligibility minimums, just given the nature and the ability to provide that liquidity. Private equity, the accessibility of it, they're not income generating. Like in real estate, there's income generation. In private credit, there's income generation. So in BDC structure, the non-traded income's coming off the portfolios. And similarly in infrastructure, a lot of them provide an income component.
And then here we have just kind of a brief snapshot of some scenarios which are directly representative of what you all are trying to achieve and the different types of vehicles which you can use that to access and create that diversification. Really, it's the way you're going to structure your diversification and allocation for clients based on their needs and what their outcomes and goals should be. So for instance, an investor who's income focused may be what we would consider an emerging alts adopter or a champion already. You may want to look at a BDC, whether it be non-traded or public, a non-traded REIT. This slide just shows how it really depends on you, your client base, your prospects, and investors. But I do think it's a helpful reference point to take a look at what you have to offer by way of vehicle wrapper. This vehicle structure at a glance wraps it all up. It can be used as such a helpful resource for advisors and prospects alike. Ultimately, many times even referencing the fact, and Josh, you've alluded to it multiple times throughout our presentation, that some of these vehicles now have single tax reporting, single 1099, simplified K-1s, monthly distributions, quarterly liquidity, et cetera, and that's helpful for clients who are starting to access the private markets to have in front of them and see the differentiation and the types of options that you all have out there.
By leveraging decades of experience and expertise in alternative investing, at Brookfield Oaktree Wealth Solutions, we are committed to providing advisors with best practices, education, and clear action steps for engaging their clients around alternatives. Our recently launched Alts Institute offers a readily accessible, action-oriented library of foundational alts curricula and marketplace insights to help guide you as you build your knowledge and expertise in alternatives. As Nicole and Josh shared, the growth of the private market space shows little signs of slowing down, as projected total AUM is expected to double in the next 5 years. With so much runway for the future, we understand that advisors will be coming in with different levels of experience with private markets and alternative investing more broadly. Our continued goal is to serve as a trusted partner to ensure advisors are getting the education, insights, and support they need to make the most of the alternative investing opportunities ahead.